In this session, we're going to cover depreciation of tangible non-current assets, focusing on the two methods, straight line and reducing balance. Businesses buy assets that help them operate for more than 1 year. Over time, tangible fixed assets wear out, become less efficient, or become outdated. Assets lose value and usefulness over time, so the business is effectively using up part of the asset each year. Depreciation is the systematic allocation of the cost of a tangible non-current asset over its useful life. Examples of tangible fixed assets include machinery, equipment, vehicles, furniture, and also buildings. Now let's move into the straight line method, which is the most common starting point. Straight line depreciation assumes the asset is used evenly each year, so the depreciation charge is the same amount every year. The calculation works like this. We take the asset cost, subtract the residual value, and then divide by the useful life. Let's quickly break down these terms. Cost includes the purchase price, all costs needed to get the asset ready for use. So it might include delivery, installation, or registration costs, anything necessary to make an asset operational. Residual value is what the business expects to recover at the end. Basically, the estimated amount you could sell it for or dispose of it for when it's no longer useful. Useful life is the number of years the business expects to use the asset to generate benefit. So straight line is simple. It uses same amount of depreciation every year. Depreciation is an expense, and it is shown in the profit and loss statement. In the balance sheet, we show the carrying amount of a tangible asset, which is calculated as cost minus accumulated depreciation equals net book value. Accumulated depreciation is the total depreciation charged on the asset to date. It is shown separately so the original cost of the asset remains visible. As a result, the balance sheet shows the asset at cost, accumulated depreciation as a deduction, and the net book value as the final figure. Now let's do a full straight line depreciation example from start to finish. A business buys machinery for £10,000. Its residual value is £2,000. That's the estimated amount the business expects to get back at the end of the asset's useful life, for example by selling it or trading it in. The useful life is 4 years, meaning the business expects to use it for 4 years to help generate income. Now we calculate the amount we're going to depreciate. Cost £10,000 minus residual value £2,000. £8,000 is the total cost that will spread over its life. Straight line annual depreciation means the depreciation is the same every year. So we take the depreciable amount £8,000 and divide by 4 years. We will charge £2,000 depreciation every year. In the balance sheet, we keep the asset's cost visible and record depreciation in a separate account called accumulated depreciation. So the balance sheet presentation is cost minus accumulated depreciation equals net book value, NBV. The original purchase cost stays the same. Accumulated depreciation charged builds up each year. Net book value reduces each year. End of year 1. We charge £2,000 depreciation for the year. Accumulated depreciation is £2,000. Net book value equals £10,000 minus £2,000 depreciation. So the balance sheet would show machinery £10,000, less accumulated depreciation £2,000, net book value £8,000. End of year 2. We charge another £2,000 depreciation. Accumulated depreciation equals £2,000 plus £2,000. Net book value is £10,000 minus £4,000 equals £6,000. End of year 3. We charge another £2,000 depreciation. Accumulated depreciation is £6,000. Net book value is £4,000. End of year 4 is final year. We charge the last £2,000 depreciation. Accumulated depreciation is £8,000. Net book value is £2,000. £2,000 equals the residual value. We don't depreciate below residual value. Residual value is what the business expects to sell for. In our second example, we will be using a delivery van. A delivery van is used daily. It helps business generate income over several years. The van doesn't lose all its value immediately, so we spread its cost over its useful life using straight-line depreciation. The van itself costs £28,800, but there are also £1,200 delivery and registration costs. Now, remember what we said earlier. Any cost necessary to get the asset ready for use must be included in the asset's cost. So we add them together. £28,800 plus £1,200. £30,000 is the figure that appears on the balance sheet, and this is the starting point for depreciation. The van will be worth £6,000 at the end of its life. This is important because the business is not using up that £6,000. It will still exist at the end. So, just like in the first example, we do not depreciate the full cost. Cost of the asset minus residual value equals the amount to be depreciated. £24,000 represents the portion of the van that will be used for calculating depreciation over its useful life. The useful life is 6 years. Because this is straight-line depreciation, we divide evenly. £24,000 divided by 6 years equals £4,000 per year. Every single year, the depreciation charge is the same. Each year, the business records £4,000 depreciation expense in the profit and loss account and reduces profit. Accumulated depreciation builds over time. Each year, we simply add another £4,000. This is why the accumulated depreciation figure grows year by year. The net book value tells us what is the asset worth in the accounts at this point in time. We calculate it as cost minus accumulated depreciation. So we see the value falling steadily from year 1 to year 6. That final figure matches the residual value, which confirms our calculations are correct. On the balance sheet, we always show the asset at original cost, accumulated depreciation separately, and net book value. It allows users of the accounts to see what the asset originally cost, how much value has been used, and how much value remains. So this second example reinforces what we learned earlier. Straight-line depreciation is simple, consistent, and predictable. We have looked at straight-line depreciation, where the same amount is charged every year. Now we are moving on to a different method, called reducing balance depreciation. This method is used when an asset loses more value in the earlier years and less value as it gets older. So this method does not spread depreciation evenly. The key difference with reducing balance depreciation is what we base the calculation on. Instead of depreciating the original cost, we calculate depreciation using the net book value at the start of each year. The calculation uses a depreciation percentage rate, not a fixed amount. This means the depreciation charge changes every year. More depreciation is charged in the early years and less depreciation is charged in later years. The calculation uses a percentage, not a fixed amount. Residual value is not deducted at the start. With reducing balance, the residual value is something we expect, not something we build into the calculation from day one. Let's now apply this method to an example. Machinery cost is £8,000. Expected life is 4 years. Depreciation rate is 20%. Expected sales proceeds is £3,277. £3,277 is not used in the yearly calculations. It simply tells us what the asset is expected to be worth at the end. We always start with the net book value at the beginning of the year. Year 1. Net book value at start is £8,000. We now apply the depreciation rate. £8,000 times 20% equals £1,600. Because the asset is new, the depreciation charge is relatively high. Then NBV at end of year 1 is £8,000 minus £1,600 equals £6,400. Accumulated depreciation is £1,600. Let's look at year 2 calculation. This is where reducing balance really starts to show its difference from straight line. We do not go back to the original cost. In year 2, NBV at start is £6,400. We apply the same percentage again. £6,400 times 20% equals £1,280. Notice how the depreciation charge is already lower than year 1. Then NBV at end of year 2 is £5,120. Accumulated depreciation is £2,880. Year 3 calculation. The process now repeats exactly the same way. In year 3, NBV at start is £5,120. Depreciation is calculated £5,120 multiplied by 20% equals £1,024. Each year, the depreciation gets smaller because it is based on a smaller value. Then NBV at end of year 3 is £4,096. Accumulated depreciation is £3,904. Now we reach the final year of the asset's useful life. Year 4, NBV at start is £4,096. Depreciation is £4,096 multiplied by 20% equals £819.20. NBV at end of year 4 is rounded £3,277. You can see that the net book value at the end is close to the expected sale value we were given. This is exactly how reducing balance works. Let's look at the summary tables. Profit and loss, accumulated depreciation, and net book value. The profit and loss table shows that depreciation is highest in year 1 and lowest in year 4. The accumulated depreciation builds up each year. The net book value steadily reduces but never reaches zero. Unlike straight-line depreciation, reducing balance does not guarantee that the asset will depreciate exactly to its residual value. Even though the amounts change, the accounting entries stay the same. Each year, debit depreciation expense in the profit and loss and credit accumulated depreciation in the balance sheet. Only the amount changes. Straight-line depreciation spreads cost evenly. Reducing balance depreciation reflects heavier use or faster loss of value in the early years. This slide now shows a shortcut formula that allows us to find the net book value after a number of years in one calculation. This formula helps us understand what is really happening with reducing balance depreciation. Net book value equals the original cost of the asset multiplied by 1 minus the depreciation rate raised to the power of n, which represents the number of years. Cost is what the asset originally cost. Depreciation rate is the reducing balance percentage. N is number of years the asset has been depreciated. Each year, we are repeatedly reducing the value by the same percentage. Let's apply the formula to our example. In our machinery example, the cost is £8,000 and the depreciation rate is 20%. The asset is depreciated for 4 years. So we substitute into the formula. NBV equals £8,000 multiplied by 1 minus 0.2 raised to the power of 4 because the depreciation is applied for 4 years. Net book value is £3,276.80. This figure matches the net book value we calculated year by year. When rounded to the nearest pound, this becomes £3,277, which is what we used in the accounts. This formula confirms that reducing balance depreciation does not depreciate exactly to the residual value, but instead approaches it. Let's finish by clearly comparing the two depreciation methods we have studied. This table helps you decide which method is more appropriate, depending on how an asset is used. With straight-line depreciation, the charge is the same every year. With reducing balance depreciation, the charge gets smaller each year. This is because reducing balance uses a percentage of a reducing value. Straight-line depreciation is based on the original cost of the asset. Reducing balance depreciation is based on the net book value at the start of each year. Under straight-line depreciation, the residual value is deducted at the beginning. Under reducing balance depreciation, residual value is not deducted up front. Straight-line depreciation is simpler and easier to calculate. Reducing balance depreciation involves more steps and changing figures. With straight-line depreciation, the net book value reaches the residual value exactly. With reducing balance depreciation, it does not reach it exactly, it gets close. Straight-line depreciation results in stable profits each year. Reducing balance depreciation reduces profit more in the early years and less in later years. This reflects assets that lose value faster when they are new. Both depreciation methods are acceptable. The correct method is the one that best reflects how the asset is used.